Welcome to the Deep Dive. Today, we're looking at something pretty intense. We're trying to get inside the head of a huge financial player right as the world, well, started falling apart around them. We're diving into the 2007 shareholder letter from JPMorgan Chase, which came out in early 2008.
Yeah, this document is fascinating. It's like a time capsule from, just before the real storm hit full force later in '08. Our mission really is to figure out what did they know back then, where did they see the cracks appearing, and what was their game plan as things got rough.
And they don't pull punches right at the start. The CEO says flat out that 2007 will be written about for a long time, talking about intense credit and capital market problems.
Yep.
But here's the kicker. They weren't just thinking defense. The goal was, and I'm quoting here, to navigate through the turbulence, protect our company, and capitalize on any opportunities.
Right. It's that classic crisis playbook, isn't it? Acknowledge the fire, but reassure everyone you've got the water and you're ready to buy the distressed assets next door. And what's kind of wild is, despite all this turmoil, markets were seizing up, they actually reported record revenue, $71.4 billion, and record earnings, $15.4 billion for 2007.
Wait, record earnings? In that environment? How?
Well, their big argument was diversification. They said their different business lines buffered them from the cyclical pain that was hitting others really hard.
Okay, that contrast, record profits during a meltdown.
Yeah.
That's exactly why we're digging into this. So, looking ahead from that point, they laid out these three imperatives, right? Strong results, quality growth, and capital strength. Intrinsically linked, they said. Let's start with those results, because you said they were record-breaking overall, but I gather it wasn't smooth sailing everywhere.
Oh, definitely not. It was really a story of two halves, especially for the investment bank. First half of 2007, amazing. They had like a 26% average return on equity, ROE, stellar.
26% ROE, wow.
Yeah. But then the second half, boom. Credit crunch hits, mortgage markets freeze up, leveraged finance stalls. Their ROE crashed down to just 4%.
4% from 26. That's a huge drop.
It's massive. Now, they did say in the letter that relative to competitors who were posting, enormous losses, 4% was rather good.
Rather good. Is that spin or fair comment?
Probably a bit of both. They weren't losing billions when others were, so relatively speaking, maybe. But that speed of decline, it must have been terrifying internally. It shows how fast liquidity just vanished. But that diversification point they made, it wasn't just talk. Other parts of the bank were genuinely booming.
Okay, so where was the strength? Which divisions were holding things up?
Well, they highlighted two big ones, Treasury and Security Services, or TSS, and Asset Management. These were the stars. TSS profits were up 28%, and get this, its ROE was 47%.
47%.
47%, and Asset Management was even stronger in some ways. Profits up 40%, ROE hit 51%.
Okay, hold on. ROE's near 50%. That's a lot. That's extraordinary. What does that tell us about those businesses compared to the investment bank?
It tells you they're fundamentally different beasts. They're less capital hungry, right? More fee-based, steady income streams, managing assets, processing transactions. These are high-margin, lower-risk activities compared to, say, trading complex derivatives. These were the anchors. They really kept the ship steady when the trading desks were getting hammered by the storm.
Got it. So investment bank volatility offset by steadiness elsewhere. But what about the consumer side? Retail financial services, RFS. The letter mentioned strong growth in accounts and mortgages.
Yeah, the volume looked good on the surface. Checking accounts grew, mortgage originations were up 34%, but the overall earnings for RFS actually fell by 6% compared to the year before.
Fell, despite more business.
Simple. Credit costs. The quality of the lines was starting to bite. That 6% drop was almost entirely because they had to set aside more money to cover expected losses, especially in home equity loans and subprime mortgages. And they knew more pain was coming. Even card services, which did okay in '07, they were bracing for losses to climb quite a bit. They forecasted charge-offs rising from about 3.7% to maybe 4.5% or even 5%. They saw the wave building across the consumer portfolio.
That foresight, or maybe just acceptance of the inevitable, it leads us to how they were thinking about the crisis itself. There's that famous story the CEO tells, right, about his daughter asking about it.
Yeah, it's a great little anecdote. She calls him up, asks, "Dad, what is a financial crisis?" And he apparently just says it's something that happens every 5 to 10 years.
Huh. Just like that, part of the business cycle.
Exactly. It shows this sort of long-term, maybe slightly detached view. They expect crises. The problem is you never know exactly what kind of crisis it will be or how fast it hits, and admitting that, it sets the stage for them to look back honestly at where things went wrong this time.
So what were those specific areas they flagged? Where did they admit they messed up or got surprised?
Well, first up was subprime mortgages and the related CDOs, collateralized debt obligations. They said they'd tightened underwriting standards 6 times. 6 times. But still, the investment bank lost $1.4 billion on that stuff. And they admitted it was substantially more than we expected. Hedging these complex things turned out to be, well, really difficult.
Okay, subprime was one. What else?
Then there were SIVs, structured investment vehicles. Now, JPM claims they mostly avoided these, saw them as too risky.
Right, the off-balance sheet things.
Exactly. But what they admitted was being surprised by just how huge that market had become, like $500 billion industry-wide. And more importantly, they called out the flawed design. Basically, as you probably remember, these SIVs were borrowing money super short-term, like commercial paper due in weeks or days, to buy assets that were long-term and often couldn't be sold easily, like mortgage securities.
Right. Borrowing short to lend long, but on steroids, and off-balance sheet, a recipe for disaster if funding dries up.
Nailed it. That mismatch was the killer flaw. When the short-term funding market froze, the SIVs had to dump assets at fire sale prices, which just made the panic worse. JPM was kind of saying, "We told you so," but also, wow, we didn't realize how big and fragile this whole thing was.
Okay, so subprime losses, SIV fragility. But wasn't there something more fundamental, closer to home for them?
Absolutely. The biggest shock, and where they sound most self-critical, was their own home equity loan portfolio. They held about $95 billion of these loans on their books. They didn't sell them off. And the losses there were rising at a higher rate than we ever could have expected, even in a severe recession. That really spooked them.
And they broke down why they got it so wrong, didn't they?
Yeah.
The lessons learned.
They did. 3 key things. First, they just completely underestimated how fast and how far house prices could fall. Their models didn't account for that kind of depreciation speed. When the collateral vanished, they were exposed.
Okay, misjudged house prices. What was lesson 2?
Lesson 2 was realizing the cumulative effect of all the aggressive underwriting the entire industry had adopted. Things like higher loan-to-value ratios, less income verification. They admitted these gradual changes had basically altered the nature of the product. It wasn't the same safe home equity loan anymore. They were lending against much riskier collateral without fully realizing the systemic shift.
So chasing market share changed the risk profile underneath them.
Pretty much.
Okay.
And the third lesson is maybe the most telling operationally.
Which was?
It was about the loans they got from outside mortgage brokers. They basically said, "We wish we'd clamped down harder on the brokers sooner." Because the losses on loans originated by third-party brokers were 2 to 3 times higher than on loans their own internal staff originated.
2 to 3 times. Wow,
Yeah.
that's a huge difference. It speaks volumes about incentives, doesn't it? The brokers had no skin in the game.
Exactly. It was a massive supply chain risk they didn't control tightly enough, and it leads to their broader reflection. The biggest danger was just following the herd. Herd mentality led them straight into the subprime and home equity mess.
Okay, so if following the herd is dangerous, you need strong internal defenses. Which brings us to their fortress balance sheet idea. They called it a strategic imperative. What did that actually look like in practice? What were they doing?
Well, it was about being really conservative and liquid. They kept a huge cushion of cash between $20 billion and $50 billion parked in overnight investments, ready immediately. Plus, they'd raised capital proactively earlier in 2007 before things got really bad.
And didn't they make a big call on share buybacks too?
Yes, that was critical. They essentially stopped buying back stock in the third and fourth quarters of 2007. Think about that. Most companies buy back stock to boost the price and signal confidence. Stopping sends a potentially negative signal. But for them, it was about preserving capital. Holding on to that cash gave them immense flexibility later when others were desperate.
That takes nerve. Prioritizing the balance sheet over market perception in the short term.
Absolutely. And it all ties back to what they called their core financial commandment. Do not borrow short to invest long, especially against illiquid assets. They pointed out that everyone who blew up SIVs, some REITs, hedge funds, violated that basic rule. Their discipline, they argued, saved them from that liquidity trap.
And having that fortress wasn't just defensive, right? You mentioned capitalizing on opportunities earlier.
Exactly. This is where the strategy paid off offensively. While competitors were wounded, scrambling for cash, or just plain frozen, JPM had the capital and the liquidity to keep lending. They actually doubled their market share in home lending in the fourth quarter of 2007, jumping from 6% to 11%. Because they could, and others couldn't. That fortress let them play offense when everyone else was retreating.
So strength allows you to seize opportunity in chaos. Okay, let's pivot to their view looking forward into 2008 from that point. They knew it was still dicey. They even mentioned the possibility of a downturn like 1982. What specific risks were still on their radar?
Well, they were pretty open about still having significant exposures. They listed $26.4 billion in leveraged loans to already indebted companies and $15.5 billion in commercial mortgage-backed securities. They made a point of showing the gross exposure numbers, not just netting things out, because they understood that in a panic, hedges can fail and you can lose on both sides of a trade. Healthy paranoia, maybe.
Yeah, seems prudent. And this ties into something else they emphasize, something more philosophical about risk itself.
Yes, and this is really important. They hammered the limitations of risk models like value at risk or VAR. They basically said you need good, sound, old-fashioned human judgment. Models like VAR are backward-looking. They measure yesterday's risk. And worse, they argued, models are often used to justify holding less capital, not more. These models gave a false sense of security, especially with complex stuff like those supposedly safe AAA-rated CDOs. Human oversight, they said, is paramount.
That's a big admission for a giant quantitative bank.
Mm.
And they didn't just critique their own models. They also had some sharp words about the rules of the game itself, the regulations.
They did. They pointed out a huge problem, that many accounting rules and regulatory capital requirements are pro-cyclical.
Pro-cyclical, meaning they make booms bigger and busts deeper.
Exactly. Think about it. Fair value accounting forces banks to write down assets when market prices fall, even if they plan to hold them. This depletes capital right when it's needed. Similarly, rules often require banks to increase loan loss reserves during a downturn, forcing them to hold back capital or cut lending precisely when the economy is weakest.
So the rules themselves can actually squeeze credit out of the system and make the crisis worse.
That was their argument. The regulations effectively force you to slam on the brakes when you're already skidding. They called for a serious rethink to make these rules less pro-cyclical, arguing you shouldn't be forced to weaken your capital base just when strength is most vital. They saw regulation as part of the problem, not just the fix.
That's a really crucial insight. Okay, finally looking ahead, what did they think about the future of those toxic products? Was securitization dead, in their view?
No, not dead. They believed the basic idea packaging assets and selling securities backed by them was still efficient and useful. But they expected standards to get way tougher. Things like CDO squared, those hyper-complex structures, they saw those disappearing. The key, they felt, was market discipline, forcing originators and packagers to keep skin in the game. If you originate alone, you need to hold some of the risk yourself. That alignment of incentives, they believed, was the real long-term fix.
So summing up this deep dive, this 2007 letter feels like a snapshot of a giant institution right at the precipice. They're acknowledging some pretty big mistakes, getting sucked into home equity risk, losing control of broker quality, but also flexing that fortress balance sheet muscle that let them weather the initial shock and even gain ground.
Yeah, it really captures that moment of realization, and it ends on this note of, well, cautious optimism. They actually predicted the crisis would ease up by the end of 2008 because of deleveraging and government stimulus. Of course, we know now that the worst was yet to come in late '08 with Bear Stearns, Lehman. So maybe the final thought for you, the listener, is about that tension. How do leaders balance rational analysis data suggesting things might improve with the brutal reality that markets can be completely irrational and unpredictable, turning solid assets into anchors overnight?
And building on that, if that fortress balance sheet is truly the key to survival, what structural changes like fixing those procyclical rules they talked about are actually needed system-wide? How do we ensure all critical financial players are built to withstand the next storm instead of having the rules themselves potentially make it worse? That's something to chew on. Thanks for joining us for this deep dive.